to my last Targets in Focus with Tony Nyman, FX Fundamentals Manager at Informa Global Markets. There's been plenty going on. We've had the US downgraded, the ECB bonds buying, and both the SNB and BOJ interventions. So let's see how all these global news events are affecting the currency markets. Hi Tony. So there's been plenty going on. Let's start with the Swissy.
Looking at Euro Swiss, if you remember back in June we last spoke, Euro Swiss had just fallen below 120, which was a big psychological mark for the markets. And then we predicted 110 in the next 3 months. We expected a further fall. We thought that was fairly aggressive at the time, but since it's just been one-way traffic and it's gone below 105, and people are talking now very quickly parity for Euro Swiss. We can't disagree with that. For two reasons, really. The Swissy is just the number one safe haven in FX markets, and the SNB, it's trying to fight the tide, but it's coming under increasing pressure. So we have low projections really for dollar Swiss and Euro Swiss. In the 1 month dollar Swiss, we think 77. In the 3 months, 79. 6 months, 80. And 12 months, 85. This might sound like a pickup for the dollar, but that's only from extremely low levels. One of the main hopes for dollar Swiss right now is that we think, unlike the BOJ, we think the SNB has the stomach for the fight, but we don't think we're talking intervention at this stage. It seems easing is their first attempt at preventing the Swiss going much higher, but we think they'll come back with, if you remember back in 1972, I know it's an age ago, they restricted bank lending, there were negative interest rates, and there's even been talk of a tax for foreign holders of Swiss bonds in the future, because the Swiss government and the SNB both want to contain the Swiss strength at this stage.
And you mentioned the Bank of Japan there. How do you see the situation developing?
Well, we'll give you our projections first. 1 month, 79. 3 months, 79. 6 months, 77. And 12 months, 80 dollar yen. Last week, dollar yen spiked from near historic lows of 76.25 to 80.25, following the BOJ's first solo intervention since September 2010. Again, just like the SNB, the stronger levels didn't last long, which suggests to us the BOJ lacks the fight to stem the tide of yen strength. And also, the market is just no longer frightened by official action, particularly of the solo variety. No one else is helping the BOJ contain yen strength, so we see a strong yen ahead. US policy particularly weighs on dollar yen. US 10-year yields are just above record lows. As we said earlier, the US economy could be set for QE3. The dollar is the funding choice, the funding currency of choice, so we back the dollar yen to remain very low.
What about the Australian dollar?
Well, the Aussie is an interesting one because it's in the last week with the S&P downgrade of the US, the shocking US Q2 GDP numbers, all the debt worries both in America and Europe, talk of a Chinese slowdown. This impacts on the risk tide Aussie. So the Aussie has plunged from 110 plus historic levels to even below parity a couple of days ago. Mm-hmm. The Aussie will continue to gyrate and probably be volatile as markets decide whether to hold positive or negative sentiment. But the Aussie will still have its attractions, and we don't think we're going to see too lower levels too much at this stage. Although obviously the RBA, a lot of people in the market are forecasting an RBA interest rate cut before year end, and we know that CBA moved on their mortgage rates earlier this week, which people tend to feel could be a trigger for the RBA ahead. For the Aussie, We're looking at maybe parity in the 1 month, 3 months, and 6 to 12 months. We think it could be 95 region for both.
And the sterling has been getting some pretty mixed reviews lately. What's the situation there?
It's getting a lot of mixed reviews. In the 1 month we have 162, 3 months we have 160, 6 months we have 158, and in the 12 we have 152. So we think the pound stays low. Especially this week, a lot of people looking for new safe havens because of the Swiss and the yen action. And a number have been looking at the pound as potentially the next safe haven. This will be because the pound has been generally weakened in the last couple of years. So in one respect, it comes from a more competitive position. And also the UK is seen as further advanced on the austerity route and potentially a more successful one than the EMU and US counterparts. So these are seen as potential positives for the pound ahead. Unfortunately, we can't really join this group at the moment. We are fairly bearish on the pound. Recent horrible UK data, evidenced by, we think, with yesterday's IP manufacturing numbers and the trade numbers, they were truly awful, and they point to potential QE2 in this country ahead. There's only one BOE official who's looking at that at the moment, Posen, but we think he could be right all along, and QE2 could be seen, again, like the US, end of this year, start of next. And obviously the market has to continue to factor out any chance of BOE tightening ahead. So we stay sterling bears at the moment.
And lastly, what are your thoughts on the euro dollar?
We don't see too much change for it. We have 1 month 143, 3 months 142, 6 months 142, and 12 months 138. The decision of the ECB to buy EMU peripherals bonds should form a relative prop for the euro. Obviously, there's been huge concerns over the likes of Portugal, Spain, Italy in the last couple of weeks. So this should help support ahead. But we've noticed that the likes of Germany, which remains the powerhouse in both economically and politically, they are not particularly pleased about the euro bonds buying. Talk of the EFSF being, size of the EFSF being increased. So at the moment we think it's basically range trading for the euro until we see fresh signals, really. So we think euro dollar, especially in the next few months, stays 140, 145 approximately.
Thank you, Tony. We'll have more editions of Targets in Focus this week to keep you in touch with all the currency movements. Goodbye for now.